Hello everybody, my name's Leith Van Onselen, the Unconventional Economist, Chief Economist at macrobusiness.com.au and the MB Fund, coming at you again with another macro breakdown, where today I want to discuss why I believe that the markets are wrong on Australian interest rates. Now, the financial markets came out with some forecasts last week that they believe the Reserve Bank of Australia will increase Australia's cash rate by 2.1 in June next year. Now, this is shown on the chart on the left-hand side, which compares the projected rate increases across Australia, which is shown in yellow, against other countries across the world. The markets are predicting that Australia's interest rate rises will be the fastest and also the biggest anywhere in the world. At a 2.15% rate increase, just to put that into perspective, would be the equivalent of hiking the cash rate 9 times in only 13 months. And that would take the cash rate from its current record low level of 0.1% to 2.25% by June next year. This hike in interest rates would arise as the Australian housing market is already experiencing a sharp slowdown. As you can see, value growth across Melbourne and Sydney has slowed to a crawl. So far this year, Sydney's only grown by about 0.4%, Melbourne's only grown by about 0.25%. So both markets are slowing quickly, and that's dragging down the national average. It's worth pointing out that if interest rates did rise by 2.15%, it would have a devastating impact on Australian mortgage holders. Now, as I show on the chart on the left-hand side, the proportion of mortgages that have been taken out over recent years at very high debt-to-income ratios above 6 times has grown significantly. In fact, over the December quarter, 1/4 of all mortgages issued were at a debt-to-income ratio of over 6 times. And it's also worth pointing out that since March 2019, 264,000 mortgages, just over 250,000, have been originated across Australia with a debt-to-income ratio of 6 or above. This suggests that there's a very large pool of borrowers across Australia that are extremely sensitive to mortgage rate increases. So obviously, if the mortgage rates increase by 2.15%, we'll see a huge impact of mortgage repayments. On the right-hand side, I projected that Australia's mortgage repayments would rise by 29%, representing an average monthly increase in mortgage repayments of $744 if the mortgage rate was to rise by 2.15%. And obviously this impact would be greatest in Sydney and Melbourne, which are Australia's 2 most expensive housing markets. If mortgage rates were to rise by 2.15%, the percentage of household disposable income going to interest repayments would also rise dramatically. As you can see, a 29% increase in mortgage repayments would lift Australia's debt servicing ratio to just below its highest ever level, which was experienced in 2008 during the global financial crisis. Most importantly, the Commonwealth Bank of Australia estimates that there's $500 billion worth of fixed rate mortgages that are due to expire in Australia over the next 2 years. Most of these mortgages were originated at rates below 2.5%. So if the market is correct and mortgage rates rise by 2.15%, this would see fixed mortgage rate borrowers have to refinance at a mortgage rate that's roughly double the rate of when they took their loan out. So it's going to have a huge impact. So what's the key takeaways from this? Well, my view is that Australians are so sensitive to interest rate rises that the market's forecast is simply absurd and would crash the property market and the Australian economy. The fact of the matter is that the RBA doesn't need to lift rates by very much to have a huge impact on borrowers. So my forecast is that the RBA instead is going to lift interest rates by less than 1% and most likely not until late this year. Anyway, that's enough from me today. Just a really quick video to go through the latest forecasts and interest rates. Remember to leave a like, share and subscribe to the channel, and I'll see you in the next video. Thanks for watching.